All right, Charlie Meaden, how are you?
Thank you for having me. I'm doing great. It's the end of a nice sunny day.
Yeah.
And yeah, happy to be here and happy to chat.
And so, for people that are listening in, just to give them a bit of background as to who you are and why we're
Yeah,
talking today,
totally.
what maybe start by telling me who you are in the context of what you're doing right now with Gembot, Gembroker.
We've been building Gembot for a couple of years now. It is an AI investing assistant and modern wealth platform. And our objective is to really democratize access to better investment opportunities, tools, and information for people around the world, but specifically Australia and New Zealand, because those are the two most expensive countries in the world to consume financial products. And relative to the level of education we have here, the financial literacy is so low. So I just think there's a huge opportunity there. And then obviously, if you then look beyond that and say, well, where is all the wealth currently held? A lot of it's in property, managed funds. There's an opportunity there for new players to come in and provide value to the market.
Okay. So before you started Gembot, what were you doing before that?
Yeah, so originally I came here 11 or 12 years ago, day after I got married. We moved out here and I was a goldsmith by trade. So I'd done an apprenticeship as a goldsmith and I was running a, self-employed manufacturing business. And I wasn't too enthused by goldsmithing and jewelry manufacturing. I was really there to make money and then spend my hobby time on gaming because I was very passionate about gaming and I was very passionate about esports and competing. So I was a professional esports player on the side and I made my money through making jewelry, specifically a lot of silver fashion jewelry we would finish that for some of the big brands out here, for example.
So what was the esports that you were involved in?
Oh, a bunch of them. I was into Call of Duty, Gears of War, Halo, World of Warcraft, and a few others. Heroes of the Storm, top two in the APAC region and top 5 in the world at one point. So that was our team based in New Zealand. So we did really well and had a few other teams that I competed in the UK when I was younger and then in New Zealand and Australia when I came here. And I was very passionate about technology and gaming. And I started retraining myself into tech and using my capital from the jewelry business to do that because it was very, very cash flow positive. So you could make a lot of money without putting in too much time if you had built some systems. So I wasn't making good money, but I was only working a couple of days a week. And that rest of that time went into learning to program, getting into technology.
And then you built an online game.
Which then we built an online gaming and tournament platform.
Right.
And that was called Uproar, and it was a bit like Air Miles for video gaming. So you'd connect all your game accounts, you would earn online currencies, headsets, keyboards, influencer experiences. We did some influencer experiences with like some UFC fighters at one point and stuff. You know, we were getting millions of hits to the site a month. We did hundreds of millions of online video views from our content, and we had about 400,000 users. And we did struggle to monetize it. Now, when you give stuff away for free, very hard to monetize, but we ended up getting acqui-hired.
Acqui-hired versus acquired.
Acqui-hired is typically where the business can't stand alone, probably.
Right.
So you need to basically be consumed, therefore acqui-hire. Not the exit that you want, but very good learning experience.
Okay, and so when was that pivot then for you personally from exiting, you exited kind of like the jewelry space into the gaming space, and then after that you
started getting into investing.
Yeah, so
tell me about I had some capital after the acqui-hire, and I came to the conclusion I couldn't do angel investing well because I didn't have enough, but I wanted the returns. Now, obviously, 5-6 years later or more, you learn that actually venture returns are often pretty terrible in most cases, and actually the kind of headline numbers are probably actually not what they say they are, especially if you consider liquidity and the fact that venture portfolios never mark their book. You know, as a public market investor, I mark my book every day, but we've got banks and venture funds and property funds that don't mark their book every day. So it's kind of an interesting, anyway, bit of a bee in my bonnet about that.
Yeah, no, I get it. Can you explain to me then, so what a systematic strategy is and Were you the first one to invent that word, even,
I
or is
don't
that
I don't believe so.
it's
Yeah.
not an algorithm or a bot that you just send loose?
Yeah.
It's more than that, right?
Yeah. So our strategy is a reflexive strategy. So we look for reflexive cycles, and it was a theory brought up by George Soros, which is basically and it's all around a mimetic behavior. So you get a riot at a sports event. Usually starts with two people having a fight, and then it expanding and getting bigger and bigger and bigger. And then you see that in markets often, where market expectation and enthusiasm between participants creates massive moves in markets. You look at Bitcoin in around that Saturday Night Live era with Elon Musk.
That's right.
You
Dogecoin, yeah.
you think about the meme stock era, SPACs. Now with semiconductors potentially is another mimetic cycle or a reflexive cycle where ultimately it ends if expectations diverge from reality too far, and then the market suddenly realizes.
Okay.
So an example here could be, oh, Sam Altman wants to raise $7 trillion for OpenAI. $7 trillion is like two of the Mag 7 combined, and you could argue that their current valuations are large and potentially stretched. And if the market was to expect that, and then he only raises $500 billion, which is still a lot of money, it's a kind of it's a bit of a random example, but that's kind of how we trade, and that can be positive or negative. So you could think about a negative reflex cycle. So one of the big trades we did early was when the market thought that Tesla was going to go bankrupt and that they couldn't scale the Model 3. We just had insights that we believed that was false. And we spent about a year buying Tesla shares all the way through like 2018, 2019 kind of thing, because we saw that what they were doing to solve their manufacturing problems.
Is there a general scan of what's going on all the time, or is this more like as opportunities or systems seem to become apparent, that's when it's programmed specifically for that event or that company that
So
might be
we're
going through
scanned to
something?
look. So there are a few different stages.
Okay.
What we're working on at the moment is an index that will allow us to actually, basically, a reflexive cycle has multiple stages. And we don't really have a good way of working out exactly where in that life cycle a company is. And if you're a short seller, the last stage is is a climax stage, and obviously that is the most dangerous time to be either long or short, right? Being able to work out and be more predictable around that would be quite interesting to us, and we've been playing with it, but again, it's not a core part of our business. It's a passion project within our entity that keeps us in tune with markets, and I think that's really important, especially when we're trying to work out, okay, well, I've got this complex systematic strategy. It's probably too complex, and why would you even want to bother going short in a way? Because life isn't more fun when you're short selling. Life is probably a lot less fun, I would say, on like net.
Yeah.
You know, I like Charlie Munger's approach, and they're definitely smart enough to be short selling. They were smart enough, or obviously Warren is, but Charlie was definitely smart enough to be a short seller.
Yeah.
But he recognized that it's a hard way to make a buck. So what we've found from this, and then from our strategy, and then trying to commercialize it and talking to users, was no, I don't really want a back testing system, or I don't know how I would build a back testing system. I actually just want to have a plan, and I want to be able to programmatically or automate my way to execute on my investing plan. And preferably, if I'm breaking my own rules, can you tell me? You know, because especially from the 2021, 2022 era, we heard so many users say, oh, if only I stuck to my strategy. Or, you know, I said I was going to sell then, but actually I just never sold.
So really what you did was you set out though, and you built the Tesla Roadster, but then eventually you got onto the Model 3, you got onto the mass market, or that's what you're working on now.
Yeah.
In terms of building a systematic strategy tool, but not dumb it down, but make it more fit for purpose for where everyday investors are really at, rather than something that's too sophisticated. Is that what I'm hearing?
Yeah, I mean, so one of the things we wanted to do was we wanted to reduce the noise because we noticed that a lot of the platforms that did have a lot of functionality were extremely noisy. Think about TradingView, for example,
Yeah.
really great tool, very noisy.
Mm-hmm.
Some of these CFD platforms that you were talking about, very noisy. I think people need less noise for the most part, right?
Yeah.
And what we're passionate about is helping people build equity.
Mm-hmm.
And the best way to build equity is basically to regularly invest, right? Someone came up to me the other day and they're like, oh, I want to make 300K. I want to make 300K a year. It's like, why do you say that? And then they were like, what do you mean? I was like, well, you should think about it like, well, maybe you shouldn't, but I was like, what about you should say, I want to earn 60K. I want to have 60K left over a year after my expenses. Because you don't necessarily need to earn 300K to make that 60K, right?
That's
If
right.
you optimize your expenditure. What I've learned, I guess, so far is that it seems like people need a plan and they need the ability to stick to the plan. And it'd be great if they had a cost effective way to execute on the plan.
Yes. It's the execution, and it's just keeping you back to that strategy, which I think is important. And that's why, like, I don't think it'll probably take me a lot longer to really understand how your systematic strategy works from a technology point of view. But I think the relevant part of that, especially for our audience, would be how technology will, if not already, but will be able to solve the problem, which is keeping us on track with what our strategy is when we forget about it, when we get taken over by the irrational exuberance of the market
That's right.
or our apathy, even. And I'm quite big on strategy because that's kind of what I talk to everyday investors about all the time is strategy. Strategy is linked to your goals, which are aligned to your purpose.
Yep.
And everything that you do is part of that strategy. And once you get that sorted out and it's solid enough, you actually don't really need to think too much about the activities because you're just performing scripts. You don't really need to think too much about what's going on around you. So if technology can help people do that, and if those strategies can then be, I guess, bespoke a little bit, that sounds pretty intriguing to me.
Yeah, I mean, what we found from investors these days is it seems like the a bit of the death to the three buckets, right? The conservative, balanced, and growth.
Hmm.
That is not how people want to represent their capital and represent their wealth
Right.
and build their wealth. There is obviously demand where people, yeah, really want to own their assets. They
Yeah.
want to vote on the company matters, perhaps. They would like strong custodianship, right? These are all key things.
Mm-hmm.
And it does fundamentally come back to no, I'm not this one, two, or three. I'm actually slightly different. I want to represent my capital in a
Mm-hmm.
different way.
A lot of people will understand the difference between active and passive investing, but I guess what we're talking about here is we're talking about taking the best of the passive investing framework and the active investing framework and melding them together somewhat, aren't we?
Yeah, you know, the diversified approach that many investors talk about. You know, you think about Ray Dalio, uh, and many other investors talk about diversification. It's been a really quite a large part of investing. Everyone talks about diversification. That's how you manage your risk. And then you look at some of the best performing investors in the world. Your Charlie Mungers, your Stanley Druckenmillers, and they've had a slightly different approach of, oh, well, I put all my eggs in one basket, but I watch that basket really intently. Most of us actually, the majority of our wealth is probably actually not going to be our stock portfolio. It may end up being our business or our career, or
Mm-hmm.
in New Zealand specifically, our home. Lots of people obviously are unable to buy a home right now. And that's why I think there's a great opportunity for self directed investing that can compound and be comparable or greater to owning a home in many ways. But you've got to have the right strategy and the right plan.
So we've got this strategy and plan, which is like that's the system, that's the structure. And then I guess the active part would be the insights and tools and the prompts that you really need. And today it would be done in the context usually of interacting with a human being like myself, talking to a financial advisor, or talking to your investment advisor, or getting out there and doing some research and really applying yourself. But are we going more into a world where technology will give us these insights based on who we already are, do you think?
So I would like to see the product get to a point over the next 12 months where you can go, hey, Darcy, one of your rules is you didn't want more than 20% of your book or your total portfolio in Apple. But I've been monitoring your KiwiSaver, your 2 brokerage accounts, and a managed fund you have, and actually you're 45% Apple, just FYI. It's great to have accessibility of information and give people the ability to level up their financial literacy. But then there's still potentially an element, well, I believe there's absolutely an element where you'll have human intervention.
Mm-hmm.
And it's about creating the right incentives in that equation. I don't overly like the idea, if I'm being honest, of meeting with an advisor once. I would rather pay them than have them basically take part of my returns every single year until I decide to switch my KiwiSaver. Mm-hmm. That's just my personal opinion.
And do you think that that would be a view shared by a lot of everyday investors? Like they would actually just want to pay for the advice they need, but just don't take a share of my action?
Yeah, we've definitely got that feedback many, many times from our user base. So there's a bunch of users that are like, I want to pay full value.
Yeah.
Why are growth KiwiSaver funds underperforming the Nasdaq and the S&P so badly? It's actually, when you look at it, you go, well, they're probably not too far off, but if you take into account the management fee and the trailing fees, that's really dragged on their performance. I don't know. I think there's a lot of room for innovation.
And so that's why I wanted to ask you this question just around what people actually want, because about 5 years ago or so, I kind of set out on a similar sort of journey in my space where I was just thinking about the way that I was delivering financial advice, which was contingent upon the implementation of a financial product,
Yes.
instead of actually just the value exchange. I'm going to give you advice, insight, and you're going to give me some money for that. And then that's it.
Yeah, that's the exchange.
And so I was trying to think, well, how can we build a model like this? And the first question that came up was, well, what do everyday investors actually want and need? And then how do we give it to them, right? And so I look at platforms like Hatch and Sharesies and Stake, and I see that they are specializing in giving accessibility to, and their revenue model is tied on to, I guess, getting in and out, acquiring and disposing. And so there's no real incentive, although I'm sure they have the best interests of their customers at heart. There's no real aligned incentive in terms of their revenue model to see them reach their objectives. And so to me, that feels like a massive opportunity for both financial advisors like myself, who can redefine their own business model, but also platform providers to, I guess, in a sense, come from the digital and reach across the divide to become more analog in a way as we become more digital in how we do things too.
Yeah, so we have a framework internally that we've actually designed our product around, and it's the 4 investing pillars, and it's based on the Herman Brain Dominance, the HBDI framework, which basically puts there's basically like 4 colors, and it's a bit like what's that other
Myers-Briggs?
Yeah, Myers-Briggs. Mm-hmm. It's similar to that, and basically there are 4 colors. Blue is analytical. Yellow is your vision and your future gazing. Green is operations and execution, and then red is relations. And actually, you need those 4 pillars in investing. You need to understand your current position. What's the data? The data is I have these assets. They are worth this. I'm earning this. I'm spending this. And then maybe I've got some debt. Mm-hmm. Your discovery, your yellow, is discovery of investments. What are the investments I would like to make? What does the future look like? How do I want to represent my capital or time to basically end up with a future that I would like to end up with, right? And then the green is execution. How do I stick to the plan? How do I make the orders that I wanted to make in the way that I wanted to make them so that I end up at my future destination? And then red is very difficult when you're a technology platform, which is relationships. But we kind of think about relationships as that actually it's conviction, because relationships help you get conviction, and conviction allows you to make decisions and be okay with the outcomes. Yeah. There's a great book. I highly recommend everyone read it. It's really shaped how I think about making decisions, and it's Thinking in Bets by Annie Duke.
Oh yeah, yeah.
You've read?
Oh no, I've heard her on a podcast, Annie Duke. She was
Oh,
like a
she
card player, right?
yeah, and
Or she
she
was.
did you listen to the one with Howard Marks and her?
I don't know.
She has a pod. She's on a podcast with Howard Marks, which is a great episode. But she has a
Right.
book. She's a professional poker player,
Yeah.
and it's all about disassociating outcomes from decisions. If I make a good decision, I can still have a bad outcome.
Hmm.
You know,
Yeah.
and that book really teaches. And in poker, that's absolutely the case,
Right.
because it's a probability game, and obviously there's other things going on there as well when you're playing against the other player. And there's variance involved as well. You can have good players that can have bad runs.
Yeah.
But it's all about, okay, with the information I have today, am I okay with that? Am I going to be okay with that decision in 18 months?
Yes. Yeah, you're basically relying on science.
Irrespective of the outcome.
Yeah.
Right? And
Yeah,
that's
so
the
there's a
really
framework.
important thing.
So you spend your time leaning on the framework rather than obsessing about the outcome that you want to get.
That's right.
You're disconnecting yourself from trying to make and manifest that outcome that you can't control anyway.
That's right.
But you're focusing on what you can control, and I think that's the beauty of it, isn't it?
It's the beauty of it, and it helps if you're trying to run your own business, or you're an entrepreneur, or you're an investor.
Yeah.
Because ultimately, a lot of what we do, especially as investors, is out of our control.
Yeah.
As a business operator, I guess you got a few more levers.
That's right.
But ultimately, how much information do I have?
Yeah.
Am I okay with that decision?
And so, just in a practical way, let's say I am using an investment platform and I have access to shares in some U.S. companies. I've built up my U.S. share portfolio, and it's just going to be rebalanced from time to time. Perhaps I've got my crypto assets over here, maybe some ETFs. So I've structured my own core satellite portfolio, let's say. Um, how how can we approach the problem of aligned incentives really well here, where the platform provider or the provider who provides access to the investor to these markets
To trade?
or to trade, to hold, whatever, uh, how can you align those incentives of that platform provider to continue to innovate and be, motivated to succeed and all that sort of stuff with the outcomes of the investor? Like, what's the best fee model, or where do you see fee models going in the future? Is it just going to be clipping the ticket on trades, or is it going to be a model that charges something based on funds under management?
I think that there are lots of companies exploring all of these
Mm.
different approaches. For us, we've gone with a very small percentage basis point approach to our transactions.
Okay.
And the reason we've done that is because if you want to, we've got this feature called multi-order. It allows you to basically create your own ETF. So you could put Bitcoin in there. You could then put 5 stocks that you like, and then you could put 2 ETFs. And then you can allocate the percentages based like a balanced like a portfolio, like a modeled portfolio. And the reason we've done that is if you were to do that on Hatch with $300, you're going to spend $30 on fees. With us, you might spend $3. Well, no, you'd spend 0.4. So you'd spend like $1.50 or something.
I see.
So it allows you to actually have, and you can have multiple of these multi-orders going, which
Right.
can align to different parts of your strategy.
Sure, I see. So you could actually be building.
So you could have 3 streams.
Right. And those 3 streams could be aligned to 3 phases of your life that you're trying to build sequentially.
Mm-hmm.
And each one of those would be a completely different blend of assets. But what you're saying is it's one contribution and it's split at source, basically. You don't have to do all the separate orders.
Yeah.
Wow.
That's right.
That's pretty cool. So we're now not only providing access to the tools, but we're giving them tools for the tools.
That's right.
Right. So it's way more powerful, potent.
Oh, it's cool.
Precision stuff.
It's so cool. I can't wait until the platform, because I do many things for our strategy every single day. They're kind of like my rituals, right? And some of them, a lot of them are automated. Some of them are manual.
So you're kind of using yourself as a test case for features that you might want to roll out on the platform at some stage.
Yeah. So I'm thinking at the moment, like, how do you delegate to an agent a part of your book? It's not to trade, but to monitor different things.
Sure.
And then potentially send me a text or create an order for me to then execute on, or you could go as far as actually executing orders from there.
Right.
But I just find it quite interesting that, really over the next couple of years, you could almost be running your own multi-strategy hedge fund within this platform, which is so far away from what it is now.
Yes.
but I can conceive a future where you could potentially use an LLM and an assistant to create some sort of statistical arbitrage for a time,
Sure.
and then use it to either help you execute or fully execute for you.
And are we talking about almost like when we say democratize investing, we're talking about democratizing a certain type of investing that's kind of typically done behind closed doors, like with hedge funds, for example. We're kind of allowing everyday people to access some of those strategies, basically, that hedge funds would use potentially, right?
Yeah, but knowing that by keeping it simple, you're probably going to have better returns, right?
Yeah.
Um,
Without the 2 and 20 model as well.
Without the 2 and 20 model, with really a cost-effective fees for dollar cost averaging, really important. And then an assistant to kind of reduce the noise but give you context.
Okay. How does this look from a regulatory point of view today? So you're a business operating in New Zealand right now, serving New Zealand-based investors. So understandably, you would be on the FSPR.
Yeah.
Right
So and that's specifically why we have two entities in New Zealand, and then we have an entity in Australia and an entity in the US. That's for us to set up our brokerages in different regions. So we have Gembroker NZ Limited, which is an FSP. That's where we do all of our compliance.
That's where provider.
That's where we work with the FMA on our AML CFD program,
Yeah.
And we're sticking to the requirements and compliance. The compliance requirements we need. We're not giving any advice. We're providing information that's generated from exchanges and other
publicly available information.
Exactly.
Sure.
We have distribution rights based on us paying for licenses. And then the broker itself is we're facilitating brokerage services. We are, again, not giving advice. We aren't prescribing people to any specific product or approach to investing. We're enabling that access. And the reason we haven't gone down the advice route so far is also because it does keep the cost low. Mm-hmm. Our cost of compliance is relatively low compared to managed funds. That's where we sit today.
Yeah.
But we see a path forward for us to go into the advice space.
Sure. Tell me about that then. So if there was a gradual move towards giving people not only the tools and sophisticated tools, but giving them more design input on what they might wish to build or help to visualize what they might build. Like how does that actually
over
work?
time? We may provide templated options. We definitely are looking to work with the right advisors.
Okay. Well, we need to have a discussion about that. Yes, definitely. Okay. So let's talk about custody as well. So this is an interesting one.
Yes.
I find that the custody conversation, it feels like there's maybe a couple of people that seem to get it or seem to want to talk about custody. And I'm referring to the risks of custody and the options with custody, because you can jump on an online share platform and you're owning an ETF, but you're not really owning it directly, right? It's being owned on your behalf.
Well, that's indirect of indirect, right? Because you might be in an LP, so you might not own any shares. The LP, the legal partnership, will own all the shares. I think there's some tail risk to owning an LP.
Exactly, yeah.
For sure.
Yeah.
If you want to vote on company matters and other things like that, a little bit complex. If you want to move your assets to another provider, I believe it's slightly more complex, and you basically have to liquidate, and then what do you do from a tax implication there?
You're locking in losses or profits, and then you have to go through the conduit of a dollar system to get back into another custodian. So how does it work right now with the platform in its current state in New Zealand? So right now with Gembroker,
as per the compliance of the regulation, we receive the money in a New Zealand bank account that's separate on a trust, which is separate from our operations, completely segregated, and then that gets remittance to our broker dealer in the US.
Is the trust here in New Zealand?
Yeah, our trust account's here.
Right. Yep. And are you connected to that trust account, or is that provided by a third party?
No, we are connected to that trust account.
Okay, which isn't unusual. Like that's kind of how a lot of other providers do it.
Yeah, we do that. And then that money gets immediately remittanced to our broker dealer in the US.
Yeah.
And then cash is kept in BMO. Securities are held with
the broker dealer in the US is
Alpaca.
Okay.
Who are a broker dealer, and then they work with BMO to hold cash. Yeah. We have our securities held in VLOX and Vision,
Okay.
And then we have fire blocks for our crypto, which is held on cold storage.
Okay. Okay. So okay, that's cool. So that, but you can see like custody is a complex beast, right? Like,
Custody is complex and important.
yeah.
And
Do you see custody kind of getting refined and getting closer to people? Like, do you see that there is an opportunity for investors to get closer ownership with their assets as there's like a move towards zero fees basically across the board? That becomes a motivating factor right there. But do you feel like investors will start to demand closer access to their investments and less steps with the custody?
it's interesting, right? Because you could say, well, it's interesting. It's interesting because a custodian should be there to protect you, right? Actually, in some circumstances, I actually would prefer an entity to take care of custodianship because they're, especially with crypto, actually, ironically,
Yeah,
right?
yeah, that's right. Even though you have
Um,
a choice, it's kind of like almost like you don't want it when you get it,
yeah,
right?
because what if I lose my keys?
Yeah.
And there's some complexity there too. Again, I think it comes back to that all your eggs in one basket. If you're going to think about kind of custodian methods, you need to be able to manage your risk
Mhm.
and make sure that you haven't got all your eggs in one basket.
Yeah.
Like you don't want all your assets on FTX. Those issues always arise, just to go off topic for a moment, when you introduce leverage and options and derivatives. Complex products
Mm.
are hard to manage risk from a platform perspective.
Interesting. That's what makes me concerned because in terms of assessing overall risk, like risk that we're not going to get our money back, like
Mm.
proper risk, not just volatility, where ups and downs in prices, but risk that we can't get our money back. If there's all these little tight tubes that we have to send our money through to get it back and put it in, then what happens if there is a mad rush for the exit, right? I'm exaggerating as if it's like a really big deal, but only because no one really talks about it.
Oh yes, totally. And it's actually important. It's less important right before when you have less than 500,000
Sure. Yeah.
because of the insurance that you get, standard insurance.
Yeah.
We have with Alpaca, our broker dealer, we got excess insurance. So it's pooled funding, but we have excess FDIC insurance
Yeah.
up to 30 million in equities and 1 million in cash.
Right.
It's
Okay.
pooled funding.
Okay.
So it's across our client base and Alpaca's client base that fall out of that 500,000 cutoff.
Right.
But obviously that's a very small minority
Yeah.
of the customer base. But I think for high net worths that actually want to think about custodianship
Totally. Yeah.
and actually address it, we would be a viable option.
Yeah.
For sure.
And so, in terms of like going forward, where do you see that? Where do you see things going? So, like, I think about how I invest right now, where there's property, crypto, shares that I own via one of these
Yep.
platforms, and then managed funds that I own via another platform.
Mhm.
Again, custodians everywhere, all over the show, just to show that I'm not scared of them. I have mortgage debt. I have insurances, other financial products as well. But where do you see this going for the everyday investor, where they're trying to look at where they're at, where they want to be, and they're trying to track how they're getting there? Do you see that there's going to be a lot more innovation to help people see clearly where they're at and kind of collate the information on everything?
Yeah, so that's again why we've split out Gembot from Gembroker from an entity relationship perspective, because Gembot, we actually don't want to be long term. We don't want to say, oh, well, if you're not using Gembroker, we're not going to deal with you, or we're going to make it difficult. No, we would actually, and obviously we've got to get buy-in from other brokers, but we want to connect other managed funds, other brokers, other accounts, so that our assistant can actually give users a better picture of their net worth and their current position. So we have on our roadmap to add other assets so that there is a sense of aggregation. And then our assistant isn't just telling you about your Gembroker holdings, but it's telling you
Mm.
about your full portfolio, and it's giving you some insights there.
We've kind of been talking about the evolution of TradFi, traditional finance. What about decentralized finance, specifically tokenization of securities?
Mm.
That's, I guess, the other side of this, which is also just developing almost independently. So you're kind of in traditional finance, but you're getting really close to the other side of the spectrum.
Yeah, so I'm a big, and this is why we built a systematic strategy rather than trying to find statistical arbitrages and just focus building algorithms around that.
Right.
I'm a big believer, and our team is a big believer, or big believers in go and eat with as many people as you can, as many different cultures as you can, and learn wisdom from many different places rather than I'm a fundamental value investor, or I'm a quant investor, or, like,
try and be a generalist.
specialize. You can. There's nothing wrong with being specialized, right? But you want as much wisdom as possible. I think that it would be great, and I don't know if the market, like, if every individual wants to learn about it, but I think auction based pricing is really important to note. And I believe that the more decentralized you get can make price discovery harder. So, you think about tokenizing assets, tokenizing stocks or equities or whatever, right? And on decentralized exchanges, you're potentially going to have some weird things go on.
It's not all, they're not aggregated into one price.
That's right.
Price bucket, right?
What we want is actually, ideally, in the throughout the world, is we want access to invest and represent our capital effectively, cost effectively, and easily. We would like good price discovery. Good price discovery is that you've got great liquidity, that you can get your money out if you want it. The spread is not crazy, and that you've got good players in the market. And I think that is also, again, like, I'm a big believer in building equity and building long-term positions.
Yeah.
However, there's always probably a right price to pay.
Yeah.
I would absolutely go out there on a limb saying I absolutely don't believe that buying a group of equities at any price is right.
Okay.
I believe in dollar cost averaging and chilling.
But you're not a hardcore passive investor.
But I do believe that there is an appropriate price for assets.
Yeah.
Drawdowns matter in your portfolio, right? Mm-hmm. We have a saying in our team, and it's just more of in the global kind of arch of our company, is, live to trade another day. Mm-hmm. And that's, again, that talks to drawing down, that talks to risk management. Like, you don't ever want to do anything that's going to take you out of the game.
Yeah, got it.
But also drawdowns matter. And I think that, it's really important to go into investing eyes wide open, right? If I decide I'm going to start investing today at all-time highs, I probably should go into the expectation that probably within the next couple of years being a bit of a stretch, probably, that I'm going to have some sort of drawdown.
But drawdown, you're talking about a drop in the market, your investments go down in value.
Yeah. But that's okay, because I have a strategy and a plan, and I am dollar cost averaging.
Yes.
However, I may just say, oh, you know what? These companies to me seem like they're a little bit, it's a little bit much. I like Charlie Munger, but he has a thing that says, stay away from extremes. Yeah. And I think that a good way to avoid drawdowns is to try and avoid extremes when everyone's talking about it. And that's why we went with reflexivity and mimetic behavior in our strategy. Because we're basically sellers of extremes, buyers where no one else wants.
Say it again.
We're sellers of extreme. So if everyone's interested in something and everyone's crowded in something, we're probably a seller. And we're a buyer when no one wants to touch something.
Got it.
But I think that trying to work out when there's like something that's quote unquote uninvestable and trying to work out when it's quite investable again, probably almost as hard as short selling correctly.
Yeah.
And I'm not saying short sell things when they're high either. No, absolutely not.
Yeah.
But I think that it's really good, I think, wisdom by Charlie Munger to say, stay away from extremes.
Yeah. Yeah.
And if you stay away from extremes, maybe you won't have a 80% drawdown in some of your holdings, right?
And so if you think about where we're going to be, like what kind of conversation we're going to be having in 5 years' time. So we're in 2024 right now. Crazy. 2029, right?
Yeah.
So let's say it's 2029. We've gone through maybe a market correction, like just get it over with, rip the Band-Aid off, right? Like hopefully there's a correction so we can kind of stop obsessing about it and it's just whatever. What do you feel like it's going to look like for the everyday investor in terms of how they interact with their investments?
I would like to see 2029 more broad-based financial literacy. And I think that's going to happen. It seems like people are intrigued by assets and how value works. I would probably see a world where there's less traditional employment and there's probably a lot more entrepreneurship, and I guess they're considered side hustles right now. There seems to be a lot more decentralized working now. Mm-hmm. And I actually think that's one of the reasons why unemployment has remained so low, is that people typically have a couple of income streams now, which is very healthy. actually.
It's diversified, right?
It's diversified,
Yeah.
correct. I think the big question should be in 2029 is potentially, is there good price discovery? At the moment, there's this talk about, this market correction, and there's a lot of fear around it. And I believe it's fundamentally because price discovery is very difficult right now, because the value of money has been distorted, because there has been a lot of stimulus and spending, lots of deficits around major Western countries, that distorts asset prices, which then in turn makes market participants believe certain things that may not end up being true. There's a lot of talk about, oh well, if interest rates go down, asset prices go up. Well, if you look at the last 8 recessions and 8 inflationary cycles, that isn't like a binary thing. So it will be really interesting to see actually how government spending looks in 2029. And I think that will affect how successful potentially something like Bitcoin is. Because, for me, I'll be transparent. I'm really interested by Bitcoin. I'm not long Bitcoin. I have only shorted Bitcoin to date, but I get it. I'm like, okay,
Bitcoin maxis that are just screaming right now.
But I understand it. I'm like,
Yeah.
okay, it's a bet against fiat currency.
Yeah.
And it makes sense. I like productive assets. I just like investing. When I invest, even though it's systematic, I like the idea of, I go and invest in this business today, which is in this building. I can go on holiday for 5 years. I can come back, and ideally this business will be more productive, have more customers, have revenue that's higher, and it's productive. I see Bitcoin as it's a quote unquote store of value, and it's really a bet against fiat currency. And it's similar to gold. It doesn't have that productivity that I like, because I believe that productivity also is a hedge against money printing, right? Because you look at something like a Home Depot that have compounded like crazy since they started, and they've been able to continuously increase their revenue, because obviously with inflation they're able to then continuously increase their revenue, which affects their valuation and ultimately their asset price increases.
Yeah,
so that's also a great
hedge.
hedge against money that's devalued.
But it's a productive hedge, is what you're saying, whereas you see Bitcoin as a non-productive hedge.
At the end of the day, if I invest in a company like Apple, it doesn't matter if we're trading in shells, Bitcoin, US dollars, NZ dollars. Like, that is a product and a bunch of services that people will exchange value for, IOUs for, in the form of money. So by having a productive asset, people will trade to consume things that they need or love.
Yeah, got it. So really what you're saying is that in the future, this whole issue of price discovery, which has been distorted by just too much currency debasement, put simply, right, should hopefully kind of become a little bit clearer, so that we can kind of see what things are worth a little bit more accurately, right?
What is something worth? I believe in a lot of the kind of fundamental ways of valuing businesses, discounted cash flow models, familiar. They're interesting to give you a gauge, but they are not the price.
That's
in a way, all that matters is the price. Right. But if you can come to terms with the price you pay, and can get to a point where, okay, I feel comfortable with this company that's growing 20% a year and has a P ratio of 15, has no debt, whatever it is. The price may be right. The price may be a little bit less than that, or the price might be way higher than that. Right. So I think price is all that matters. And I don't think that it's appropriate to say, oh, well, this is the value and that's all that matters, because unfortunately that's not how markets work. But at least if you have some ways to come up with a framework for how you value something, you can come to terms with the price you pay. And I think it's important to note as an investor that the price you pay does matter. So, and that's why learning from lots of different wisdom and lots of different paths and people that kind of think differently can give you a nice internal framework for yourself to work out how you want to represent your asset base.
Yeah, that's good.
All we're trying to do is build up our equity, right?
Yeah.
Like as someone trying to get ahead in the world, you're trying to use your time, computational power, or capital to build your equity base.
Mm.
And hopefully by the time you get to 60, 65, you've got enough equity that you can either live on it or draw down on it so that you can have, I guess, a good kind of end.
Finally have that time where you can actually make some choices, right?
And help the next generation, right?
Yeah, intergenerational wealth. And so it's an interesting chat, right? Like I think that the world is changing so fast, both with stuff that we can't control and stuff that we can control. Like you were saying just before, ultimately we want to get to a place where we've got enough money that we live the end of our days happy and pass it on to our kids. But when the world is shifting, including shifting value of our currency, which all our investments are denominated in, that's where you have this weird sort of slippery thing going on where it's just really hard to know where you stand. And is a $300,000 lump sum at time of retirement, is that going to be enough to get me through the end of the days? Or is it not enough because even though it might be adjusted for inflation, the things that I will consume will be so much more expensive because there's going to be way less government involved. I don't know. Like there's all sorts of weird dynamics that we have to throw into this, right?
Yeah, and again, like everything in society and life can come down to all reflexive and mimetic behavior. Right. So you have massive swings to lots of government and big government, and then you've seen in the past where things have swung away from that. And it's kind of a pendulum of this mimetic behavior that happens in markets, it happens in culture, happens in government.
Yeah.
And I don't think we can predict how involved governments will be.
Yeah.
I wouldn't go on one side or the other in terms of how much government intervention you should have. I'm actually all for government intervention, providing governments are fiscally responsible, right?
Yeah, that's the ultimate test right
so
there.
Be super involved. I'm really keen on that. Just don't have a $2 trillion deficit when you're supposedly the lowest unemployment rate and best economy you've ever had.
Apparently.
Right?
Yeah.
So
yeah. No, that's cool. Man, there's a lot more that we could chat about. But
totally. It's been awesome. Thank you.
Really appreciate that. Now, if people want to follow what you're up to, Charlie, what's the best platform? Is X the best platform to follow you on?
Yeah, LinkedIn's great. Charles Meaden on LinkedIn. That's always good. I am at Cyborg Charlie on Twitter or X.
Awesome. Well, thanks very much, Charlie.
Yeah, thanks, man. Really appreciate it. Cheers.